Welcome to the What to Watch video update. This is the last video that I do over the weekend, and I go through and I look at all of the charts that we need to be paying attention to right now, and I arrange them in three categories. We look at the positive charts, we look at the negative charts, and then we look at charts we're just watching to see what they do because how they react could have an impact on the S&P 500. And I put it together in this video. Now, all the charts that you're going to see in this video, I update every day with a daily video. I also do a video each week. I do an intermarket analysis video. Right before this video, I do a video called the deep dive video where I go over the charts that I'm not really looking at right now. And there are also some charts that are unique to that particular video, where this is the video. Okay, this is what I'm really watching right now. Okay, this is being prepared for Monday, February 3rd. First, we look at the positive side of things, and things are still looking fairly positive overall. Now, there's some positive sides to this chart and some negative sides to this chart. We were looking pretty good if you go back to Monday. Now, a week ago, we got caught off guard. There was some pop news that hit, and it was that China came out with this deep seek and freaked everybody out. It came out over the weekend, so the market didn't have a chance to react to it until Monday. And so that produced this really big gap down. But after the open, we didn't keep going down. We saw a lot of smart money coming in and doing some buying here. We look at other indicators saying, no, they were using this as a buying opportunity. Okay, then on Tuesday, we ended up having a nice little upward move. Wednesday was the day the Fed met, so things kind of gyrated a little bit. Here is the reaction after the Fed made their announcement, and we ended up being pretty much in a treadmill state at that point, where we kind of ended about where we started with that whole thing. Then on Thursday, we looked to be opening higher, came down, and then saw some strength going into the close. And now the markets are trying to digest this whole tariff talk. That there was some, and it's not like this is a surprise either. This is something that Trump talked about in the campaign, and now it's starting to happen. This is February 1st and February 2nd. This is the weekend, and this is when he said it would kick into gear. So the market's not really surprised by this. They just thought, well, maybe there'll be some last minute negotiating, some last minute deals. Well, if you go back to the way the federal government made money 100 years ago, it was through tariffs. It was in 1912, 1913, I believe, when we had the Federal Reserve Act and the income tax. Of course, it's only going to be for a short period of time and it's only going to apply to really wealthy people. Yeah, right. That's not how government programs work. That's how they sell it to you at the beginning, and then it ends up becoming permanent. And so then we switched over to the government getting their money from our income instead of from other countries by trying to sell products in the US. And so that happened a little bit on Thursday. Came down, then went right back up. So we saw a quick bounce there. Then we came out on in Friday's session and we're looking pretty positive. We had the core PCE come out. Now it's still showing inflation, but it came in as expected. And so the market was ready to gap higher, and we went all the way up to this R2 intraday pivot point. Now, I update the pivot points for the next day on the YouTube community tab. These are very important because you have about 60 to 90% of the volume every day that's done by computers. It's not done by real people. And they're programmed with these things into them. When you get up to R2, start selling. When you get above R1, start buying. Okay, that's some of what they put into these machines because they're trying to remove all the emotion from what's going on. Well, we went up to this R2 level, and that was the intraday high, and things were looking pretty good. Apple had come out with an earnings report, was looking pretty good. Now, as the day went on, it started to come out that maybe these tariffs are actually going to kick in anyway. But look at the chart here. This happened before they started really worrying about the tariffs. Now, there are times, like over last weekend, the news happens first and the market reacts to it. This is one of those things, just to keep an open mind about this. We started seeing price show some weakness, and then it started to really decline. This could, I'm not saying it is, but it could be one of those instances that does happen sometimes where you've got the market leading the news. And then we came down and we ended up giving up all the gains on Friday and actually closing lower, but we found some support at this S1 level. Again, this is a level that we know about even before Friday's session. So that's why I watched this. We pretty much closed right at that level. So we're wondering, is the market going to use these tariffs as an excuse to start turning more negative? Not saying that's what will happen, but we just want to keep that in the back of our mind. And that's one thing I'm watching right now to see how things open on Monday. Another thing that's happening is in the short, intermediate, and long term, we're not trending right now. We have a short-term ADX. That's what I use to measure the trend. We're below this blue line, which is 20, and we're below the moving average. That means in the short term, we're not trending. If we were trending, we would be going up with the ADX. We would be above the moving average, and would be above 20. However, this chart is still positive because the green line is above the red line. Then we look at the intermediate term trend. Also below 20, below the moving average, green line on top. So we're still positive in the intermediate term, but not trending. Then here's the weekly chart going down with the ADX below its moving average, below 20, but the green line is still on top. So on all time frames, we're still positive, but we're not trending right now. Is the market getting ready? Because the longer we stay below this level of 20, especially when you have all three time frames lining up, the bigger the move is going to be. It's like winding up a toy or a coil or something. The harder you squeeze it, the more it's going to react in the opposite direction. We're not quite sure. Is it going to be to the downside? Is it going to be a shot again to the upside? That's what we look at other charts and why I follow this on a day in and day out basis to try to evaluate those things. Okay, then another thing that's positive though, even with the decline that we saw on Friday, if we go back to about the 28th of January or so, and we look at an intraday chart based on 10 periods of growth versus value, this is still going up. And we want growth to be outperforming value. When value starts to outperform growth, that's when the market's getting more defensive. And this happened last Monday. We really gapped down. We finally hit a bottom here and we've been bouncing back up. So there's the negative side to this that we broke out of this range that we had been in, but we've been in an uptrend going all the way back to the end of last November in 2024. We were kind of going sideways as the market was just kind of meandering around, going up, going down. This is still looking okay on a shorter term basis. And so that's why I put it on the positive side. We're also looking good here. When we look at large cap growth versus large cap value, even though the blue line came down, the red line also went down, and the blue line's still above the red line, even though these are still on different scales. This is still looking more positive. We look at an end of day chart. Small caps, which have been a real disappointment. You can see right here where I'm circling. We've just been chopping along sideways for quite some time. But the growth to value ratio for the small caps still is holding up quite well, showing that growth is outperforming value. Mid caps also disappointing right now as far as the overall movement to their index, but they actually went up a bit in Friday's session with the rest of the market going down. And we're holding up fairly well with the S&P growth to value ratio. So we're not seeing a lot of internal selling right now, which if we saw these ratios going down, that means the market's getting ready to get more defensive. We're not seeing that, at least yet. This is a little bit more of a concern. We take a growth ETF and a value ETF and do a ratio between the two, coming back down into the rainbow, but not really falling apart here, but definitely showing some weakness. But it's still positive overall since we're kind of hanging in there. And also you look at the context of the other growth to value ratios that we look at. Discretionary to staples still holding up quite well. This is Amazon. This is Tesla. Staples, toilet paper, toothpaste. When this is going up, that's more positive for the market. This has been one of the most positive areas of the market, if not the most positive sector, going back to the end of the world day that we had last August, that lasted a day or two, and then we went on to the next end of day type of event. Large cap growth did come down, not really breaking to the upside, but still hanging out above its 50-day moving average. And I measure the intermediate term trend by the 50-day moving average, and all the lines are still going up. Then here's some other growth to value ratios here. We look at the Qs to S&P coming up, but the moving average is declining. Discretionary to the S&P above the moving average. This is stronger area. This is a stronger area of the market. We're seeing a little bit of a weakness here when we compare large cap growth to large cap value. And this is end of day, where the other charts I look at are more intraday. Then we look at the large caps coming in under a declining moving average. The mid caps are looking good here and looking kind of weak, but coming back up to the moving average with the small caps. The daily chart. And the reason why I brought this up, often I don't show it in this particular video, because we're starting a new month in Monday's session. It'll be February 3rd. We have new pivot points. And this is another thing that I update every day on the YouTube community tab because these pivot points last for the whole month of February. Now, why is this positive? It's because we're coming in above the P. That's P for pivot point. If we go up, this is known as R1, resistance level 1, resistance level 2. If we go down, we have S1, S2, which are support levels. Because we're above this P, we're above the 50-day moving average, this is being treated as positive for right now. Also, longer term and internally in the S&P 500, we're seeing a lot of improvement when we look at the highs minus the lows and take a 10-day average of that. We had come down to a very low reading, and we've just been inching our way back, 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 back. Now we're getting back above this green line. Now, on one hand, you could say, oops, we look at this like an oscillator. When it's above the green line, that means it's getting overextended. And that could be what it's telling us. But at the same time, we spent most of 2024 and a lot of 2023 and a lot of 2021 way up above this green line. That shows longer term strength and longer term momentum. And to see this improving for right now is positive. We also look at a little further out, a 50-period moving average of the new highs, new lows for the S&P. We had been declining. We're still continuing to go back up. That's positive. We keep an eye on the VIX. Now, even with the decline that we saw, because we were really doing good right after the open on Friday, and we ended up being down on the day, the VIX really didn't move all that much. And we're still under 20. So I'm treating that as positive for right now. The momentum, even though we're going sideways with the MACD here, we're still negative with the momentum. We're still going down. Now, if the MACD crosses above the moving average, then that's going to turn the momentum of the VIX back up, which would be more negative for stocks. Then this is research put out. The numbers were done over a year ago, but this was research put out by Tom Bowley. He's connected with stockcharts.com and earningsbeats.com if you want to check those out. I have no connection to him other than this is a chart. I watched the video. I like this chart, so I use it, but I wanted to make sure he gets credit for that. Why is being under 20 with the VIX so important? Well, if you annualize the returns when we're under 20, they're positive. And the further we go under 20, the higher the annualized returns become. When we get above 20 in this red area, that's when annualized returns are negative. So that's why I'm saying we're below 20 right now. So that's positive in and of itself. Now, there's a variation of the VIX called the skew index, where the VIX uses at the money options, if you know what those are, to do its calculation. Well, the skew index uses out of the money options, either above or below current price. And we've been getting high readings up in this red area. And that just means the market is expecting some kind of a big move. And we're not really sure if it's going to be up or down. There's some research that I ran across that suggests the market's still expecting an up move, which might explain why we're going sideways. Because the market's like, okay, we don't really want that to happen. If a lot of people are expecting some big event, big move one way or the other to happen, the market has a tendency to do the opposite. So, but this is coming down, but still giving us an extreme reading. Now, even though we took a bit of a hit on Friday, the advanced decline line based on price and volume are holding up. They're above advancing moving averages. We're still positive here, although we are declining. This is a 10-day average of the advanced minus the decliners. That turns this into an oscillator. And we were getting a very, very high reading. Now we're starting to come down. The reason this is positive is we're above zero. But if you look at this, other times when we hit a high reading and came down, we either went sideways. Here, we hit a real high reading and we actually started to decline. This was into the end of the world day back on August 5th. And then other times it just marked that we chopped sideways for a while. So we want to keep an eye on this. Sometimes this gives us an early warning. We're still looking good here with the new highs, new lows. We're seeing more new highs than new lows, more green than red, like the Canadian TV show. But we're seeing a pullback in the new highs. However, the 5 day is still going up, but rolling over just a little bit here, but still positive. And the 10 day flattening out a little bit, but still going up. So this is positive. We're taking a bit of a hit with our short and intermediate term advanced decline ratio, but we're still above zero. So that's still positive there. And for the reversal that we saw on Friday, we didn't see much of a change with our cumulative advanced decline line for the S&P based on price or volume. They came down a little bit, but they didn't fall off the edge of the earth here. And the vortex, even with the decline that we saw on Friday, it picked up something positive, and we're seeing the green line going up and the red line going down. This is one of the many primary indicators that I look at to determine the overall climate in any given time. Volume is above average. I have that on the positive side. That just means there's a lot of participation, even though we're not trending right now. The condition of the short-term trend, as measured by 20 periods, the lines are still going up. Now, if we fall below the blue line and the green line here, that's going to turn these lines over. But for right now, it's positive because we're still going up. This is a simple and exponential moving average. We're still above both of them. So that's positive. This is what I use to determine the short-term trend. The condition of the 50-period moving average, that's the intermediate term trend. We're still above the green, excuse me, I know my colors. We're still above the blue line here, and they're both going up. So that's still positive. If we continue to fall, we'll be watching the 50-period simple and exponential moving averages. So we look at all the moving averages here, and the reason we're close between the 20 and the 50s is because the 20s actually came down and dropped below the 50s there for a while. So these lines are not very far away from each other, and they could hit any one of them. If they slice through these to the downside, yeah, that means support is being lost. If we come down here and bounce up off one of those, that could be acting as support. On the daily chart, the parabolic SCR is positive since the dots are underneath. Also on the weekly chart, for the second week now, we have a dot underneath. So daily chart, weekly chart, both positive here. Now we're still positive with the NYSE McClellan oscillator, even though we have been declining after getting extreme positive. The reason this is positive is we're still above zero. When this is above zero, we're going up with the summation index based on price and volume. So this is still positive here. And then we look at the momentum in the short term. I have two short-term oscillators, three intermediate-term oscillators, and two long-term oscillators. They're all still positive. Then we look at those stocks inside of the S&P that are above their 20-period moving averages. We had become quite extreme here. When we get above 80, that gives us a little cause of concern, meaning we're getting a little exuberant at that point. Well, when we break above 70, that's showing good short-term momentum. We're coming down and we're just slightly under 70 right now. So this is still positive since we're above 50, but it is showing some weakness. And we see that here. This is that same thing, just marking the 70 level instead of the 80 level. And so we'll just keep an eye on that. Stocks above their 50-period moving average did decline, but still above 50. Declining, but still above 50 with the stocks above their 100-period moving average. But we are seeing some weakness coming in. And we declined, but still well above 50 with those stocks above their 200-day moving averages. And we actually went up a little bit with the bullish percent index. What I like about this is this isn't a moving average. This isn't an oscillator. This is a completely different kind of indicator. This measures point and figure buy or sell signals inside of the S&P. And we actually ticked up. So this is another primary indicator that I use that is still positive. And we're also still positive with the NYSE bullish percent index, and we went up with the NASDAQ 100 bullish percent index. So we're seeing confirmation across different indexes. Now, this is actually positive, but could be negative at the same time. And I've been really pointing this out in the daily videos. This is a trend channel that I drew on here, so we don't know how exact these lines are. But it goes back to 2009. And we're hitting the upper end of this trend channel. Is that producing some kind of overhead resistance? So far, we would say yes, because we have not been able to break really above this with any conviction. We got above it back in 2021 when the market was just, hey, just throw money towards the market and it'll automatically go up. Well, then we went into 2022. So that's why we're watching this area right here. If we start to come back down, that could be longer term negative. But because we're still up at the upper end of this, it's still positive. And here's a weekly chart going back to the 1987 crash, still positive there. Then we look at the broad market, the cumulative advanced decline line for the NYSE coming down, but still above the moving average. The NYSE regular advanced decline line is still above this moving average here, but chopping more or less sideways right now. And then we break it out based on common stock. We were looking better and then came back down based on price. Went up, came back down based on volume in Friday's session, but these are still holding up fairly well. We are seeing some weakness with the advanced decline lines, but they're still positive since they're above their moving average. The only one that's starting to drop down to the moving average are the small caps, which have already been a disappointment anyway. And then we look at a broad market measure of the highs and lows and take a 5 period moving average of that, coming down a little bit, but still above zero. Then we look at the NYSE new highs, new lows, and there's a red line in here, which is still positive. And we look at the Dow, which had a shot at making a new all-time high here, but didn't do it in Friday's session, ended up being down 0.75%. It's still positive because we're above the 50-day moving average. Looking at the NASDAQ 100 with the new pivot points in here, we're still above this pivot point now. We're still above the 50-day moving average. If we drop below that, that's going to turn things more negative. The Nasdaq, the same thing, and I know it's hard to see because we have all these labels in here, but we're still above this pivot point, still above the 50-day moving average. So that's positive there. And we're going sideways right now, but the momentum is still positive for the Nasdaq 100. If we drop below the moving average, that's going to turn this negative. Mid caps, the reason they're positive, they even though they came down, they're still above their 50-day moving average. And the bank ETF, this is a concern that I was pointing out a week ago. Can we get above the 50-day moving average? The answer now is yes. And so far, we've been able to stay above that. And the financial sector, still looking pretty strong now. We want that to be doing well in a more positive environment for stocks. The Wilshire, kind of going sideways recently, but still above its 50-day moving average. That's a broad market measure. Another broad market measure is the total US stock ETF, also above its 50-day moving average. The FANG index, these are the real big Facebook, Apple, Amazon, Netflix, Google, Nvidia. It was actually up a little bit in Friday's session and still above its 50-day moving average. We are watching this. This is a longer term chart of the FANG index. It came down to this longer term trend line. And if we start to go up, is this shorter term trend line going to provide overhead resistance? It did earlier on in 2025. We hit that level and came back down. So we'll see if that's going to be a problem again. Now, if we break down below this longer term trend line, now it broke down below this before and we were able to recover, but we're going to get a lot more negative if we do drop down below this trend line. We look at a ratio between the QQQs, which is the NASDAQ 100, and the IWM, which are small caps. This ratio is still holding up quite well above this blue line. And we look at the market's anticipation that we're going to have a soft landing. This is a ratio between stocks and bonds, still going sideways, but still above the rainbow here. And that means that we're not going to go into a recession. That's what we call a soft landing. And we look at a broad market measure and look at shorter term bonds, still holding up quite well. Another broad market measure, a little further out, that ratio is still holding up in favor of stocks. This is where we're seeing a little bit more weakness. The tech sector to the 3 to 7 year bonds coming back down into the rainbow because tech has been a little bit under pressure lately. And then this is also tech, the QQQs or the NASDAQ 100 against 3 to 7 year bonds coming down, but still at the high end of this rainbow. We look at a ratio between the NASDAQ 100 and the Dow coming down a little bit here, but still above this very high reading that we've been getting. And the NASDAQ 100 weekly chart still above this long-term trend line. Now we go to the negative side. And this is something that if you watch this, because I record these videos and I have a program with a website. The people that are members in that program, they get access to the videos right when they're available. And then I'm going to be starting a service where if you want access to the videos, but you don't really want to be in the program that I have, it'll be a fee-based type thing where you also will have immediate access to the videos. You just don't have access to the courses that I teach and other videos that I do produce. Well, then I wait to put the videos public. It'll be after the close on Monday. So this is going to be old news if you're watching this after it already happened. But I'm preparing this over the weekend before the market even opens. Well, we were coming down here because this is an extended hours chart of the SPY, the ETF attached to the S&P 500, where we were looking pretty good there, right, to start off the day, and then we switched and started coming down. Right where I'm circling right now, that was the close on Friday. Well, it keeps trading a little bit after that before it gets ready to shut down for the weekend, and we saw more of a decline after that. And so, what's going to happen Sunday afternoon or evening when the futures start trading? Are we going to have a gap lower that's going to reflect this weakness from Friday session? Or are they going to go, wait a minute, things aren't so bad. We're going to see more of a gap up here. I start watching the futures about 6 p.m. Eastern time on Sunday. That's when they start trading. And I'll be watching that and we'll see what the reaction is going to be. But since we're declining here, I'm treating this as more negative. All right, we're looking at sentiment. That's more negative now. We were improving as we were going up, but then we got to 50 and then started to come back down. And we're looking at some concern with our smart money indicators. I have three of them, and this is the first one. We're positive, but we're starting to roll over, and we were getting kind of far away from this moving average here. And when we get too far away, it has a tendency to come back to the moving average, and that could actually turn this negative. When it becomes full-blown negative is if we fall below the moving average, but we're far from doing that. So this one is still positive, but just a little bit concerning to us right now. Where we're looking even more concerned is another smart money indicator called the Chaikin money flow. We came down on Friday with the histogram, and now the red line's starting to go down. That's actually turning negative. And then with the third smart money indicator, we are negative. We came up with a very high reading. We're starting to go down. We're below the moving average that I have here. So we're more negative when we take the three smart money indicators together. And this was actually giving us a signal a week ago. And it's the Swenlin trading oscillator. It had a very high reading here and then started to reverse and then just kept going down, down, down. We were trying to recover there for a little bit, but now we're declining based on price. So this is negative. It's even more negative based on volume because now we're dropping below zero. And the S&P McClellan oscillator, this is still positive because it's above zero, but we had a very high reading and we're starting to come down now. But the reason I have it on the negative side is because of the next chart. We're still going up based on price with the summation index. And that when we're above zero with the McClellan oscillator, that's when the summation index is positive. But if you look at volume here, and this is a completely different indicator, I just have them plotted on the same chart here. This is looking at volume. We're turning down with volume right now, and sometimes volume leads price. So we're still looking okay here with price, but we're turning negative here based on volume. That's a negative divergence right now. This is a primary indicator that I use, and this is throwing up some warning signs. Now, a good solid day on Monday could change all that. But is this starting to tell us a story that's looking a little bit more negative? Until proven otherwise, we just want to be aware of that. Okay, then this is the mass index, and I don't know if this is legitimate or not. This has been triggered now for a few days, where there's three criteria. Criteria number one is when we go above the dashed line, the red line here. Criteria number two, we go above the blue line. Criteria three, and when it's the signal has been generated, is when we come back down below the red dash line. And whatever the market was doing to generate that signal, which basically we were going up, it's expecting a reversal. Now, we don't know, and we're going to use other charts, but this is signaling something where there's some concern in some of the other charts that we're looking at. So we're taking a big picture approach, or the consensus approach is what I call it, and just saying, yeah, there's some weakness out there. We'll just keep an eye on it. We'll see how Monday looks and see if things are going to develop into even being more negative. All right. And then small caps are negative here, even though their longer term trend is positive. They're just chopping sideways below their 50-day moving average. This is the S&P 600. I also follow another small cap index, the Russell 2000, also below its 50-day moving average right now. That's why that's negative. And when you do a ratio between the small caps and the S&P, small caps continue to underperform. Semiconductors, they were looking pretty good. We were breaking out above these previous highs on a closing basis. Well, then a week ago happened with DeepSeek, sent this all the way down to its 250-day moving average and trying to bounce back up from that level. Because of the big drop, I'm treating this as more negative for right now. It's going to be even more negative if we fall below this 250-day moving average. Interest rates, that's what's really been pressuring stocks lately. And if these can go back down, that would be more positive. But we're watching that 4.5% level. On this chart, that's 45. And we tried to deal with that, but we're still above that 4.5 level. Because when we were seeing interest rates going up back in December, this at this 4.5 level, this is when stocks started to wake up and go, wait a minute, interest rates are going up. I don't like that. I'm going to go down. I'm going to sell. Well, if we can break down below that 4.5% level, that might be more positive for stocks. So what I've been watching is an intraday chart based on 10 minutes. And you notice here on Thursday, we actually got down below it, but then we went right back above it and it acted as support. And then Friday, it looked like we were going to give this another shot, coming down to the 4.5 level. And then everything kind of started to switch, and interest rates ended up going back up as the day unfolded. So that's negative. If we can break down below 4.5%, that might be positive for stocks. And we're looking at this. This is negative, where the home construction to 3 to 7 year bonds had been positive for most of 2024. And we actually saw some weakness, but bounced off this support level. Not this time. We broke down below this support level and still looking more negative here. Keeping an eye on a daily chart here of yields, where what's the overall trend? We have been going back up. We were starting to go back down. If we continue to go down, that will be more positive. And we look at a ratio between semiconductors and the Dow, we're a little bit further away from this blue line. That's why I have it more negative. So what are some things that I'm watching? We want to keep an eye on jobless claims, which actually declined this past week, which shows strength in the economy. Continuing claims also declined, but the moving average is still going up. That also could show strength in the economy if this continues to decline. And I put all this on here with the continuing claims, initial claims. We're going to get an update of the unemployment rate on Friday. That's when the employment situation report will come out. And we're looking at the interplay between different types of bonds here. We're looking at cash versus 3 to 7 year bonds, where we had been going back up. That means cash is outperforming the price of bonds. And that's what happens when people are worried about interest rates going up and inflation going up. Well, we're coming back down to the 50-day moving average, even though this is in an uptrend. If this could continue to fall, that would be more positive from the inflationary front, and that means interest rates are probably going down too. If this continues to go back up, if we find support here and turn up, that'll probably be more negative for stocks. Not as pronounced here when we look at a thing called TIPS. These are Treasury inflation protected securities. When interest rates are going up and when inflation is going up, people want to be in TIPS because they adjust for inflation. You can roll them over into a higher yield, or you can't do that with 3 to 7 year bonds. And so when these go back up, that means people prefer TIPS. When this is going down, people prefer 3 to 7 year bonds because they like locking in that longer term interest rate. Well, we've just been chopping around here, not really showing that much when we look at TIPS to 3 to 7 years. But when we look at from TIPS to 7 to 10 years, we go further out. Now there's some concern. We're seeing the long end of the yield curve going up. This is the 10 to 20 to even 30 year bond that we're seeing. And this is causing some concern. And this is still going up. Is it going to keep going up, or are we eventually going to come back down here? And we're watching international yields on the 10-year bond, specifically in Japan. When we got above 1%, this was last August, and this is when the world was supposed to end. Well, a couple days after that, we dropped down. Now we're going back up. And a week ago, the Bank of Japan raised interest rates. Is that going to produce more of a problem in Japan, which could bleed over into Europe, which could also bleed over into the US and give us another end of the world day? We want to keep an eye on oil. Now, the new administration is really promoting the idea of lower oil prices by talking to OPEC and Saudi Arabia and just saying, you better lower the price. Yeah, like, okay, but there's going to be some action behind that. But this can also really react to geopolitical events. There's still a war going on between Russia and Ukraine. There's still all kinds of crazy things going on in the Middle East. And if oil spikes up for any of those reasons, that could be more negative for stocks. And we want to keep an eye on the dollar. It's still in a longer term uptrend, even though it's been pulling back lately. Thank you. I really hope you found this helpful. Have a really good weekend, or if you're watching this later, have a good week. And I will talk to you in the next video.